Hello. Hello, everyone. So, we've got a really good session for you today. We're going to dive into some financial health. So, when a business is ready for sale and you go through some form of due diligence to understand the financial performance of that business, you need to understand its financial health. And what I mean by that is there are four key ratios that you can use to check the financial health of your business. So understanding things like how effective is the business at putting assets into use? How quickly can the business satisfy short-term commitments? How can the business satisfy debt? So is it heavily funded by debt from the bank or from a lender or from a financier or from other shareholders? And therefore, how much equity is in the business that can potentially satisfy that debt if it needed to? And also, how profitable is the business? And that's what we're going to cover today with a bit of an example of profitability. I'm Ian Smith, TheStrategySmith, management consultant and business coach. So I've worked with businesses and business functions across all sectors, across the world, and I've had to dive in and understand quickly financial performance of other businesses. I also am a master project management certificate holder, and so I'm an expert in project management as well. So check out TheStrategySmith.com and you can see all of my credentials and the services that we offer. This is going out on LinkedIn, TikTok, Facebook, X, and YouTube. So as it's going across all 5 platforms, it would be fantastic if you could like and comment, but I might not see all of the comments come through because we're going across all 5 platforms live. So let's dive into financial health. So in terms of financial health, there's 4 key ratios. Now, when something is a ratio, it means it's divided by something. And we're going to talk about the profitability ratio in a bit more detail. So there's 4 key ratios that you can think about. You can look at activity ratios. We'll draw these over here. Activity ratios. So that means asset management. So how is the business utilizing its assets within the business in terms of asset turnover? So you can think of asset turnover in terms of how the business is currently using its assets to put into use for the business. And we're going to cover the different ratios in each of the lives. So we're going to cover profitability today. Then liquidity. When a business is liquid, it means it has liquid cash. And how can it satisfy short-term needs with the current assets, the current asset within the business? So does it have sufficient liquid cash to satisfy the current liabilities in order to pay bills, satisfy short-term debt, etc.? So that can be established via a quick ratio. We'll put their turnover as well in terms of the ratio. So if a business is liquid, then it can satisfy short-term liabilities. Solvency. So if a business is solvent, it means it's essentially geared with equity to satisfy long-term debt, long-term commitment. So ability to satisfy debt. And what you understand is the short and long-term liabilities over the amount of equity that's within the business. And that can be established via a debt over debt plus equity ratio. And that gives you an understanding as to how the business is geared, how heavily it's funded by debt as a percentage compared to the equity within the business, and how much equity is in the business. So the gearing of the business. And then, of course, profitability is what we're going to cover today. This can come from gross profit percentage. It can come from EBITDA percentage, of course, then EBIT percentage as well. And then you can look at profit before tax, or profit before tax, profit after tax as well. And profitability, profitability. So it's the ability to manage expense to provide profit from sales. So I'm going to say that again. It's the ability to manage expenses to produce profit from sales. Now, as a business owner, an entrepreneur, a salesperson, someone who needs to know their numbers in terms of sale price, needs to also understand the cost of expense to the business when producing a service or a product, so that they know how much profit is going to be made to determine the sales price and also to determine the amount of profit that is built back into the business. And we're going to look at that with just an example profit and loss statement. So there's three statements within a business: profit and loss, cash flow, and balance sheet. So we're just going to explore an example of a profit and loss statement right now to show you the way of thinking that you can apply. One, to understand profitability in other businesses. Two, to understand things like accretive margins. And three, to understand how you can manage expenses and cost to the business to provide profit back into the business, i.e. profitability. Do you have profitability? So we've covered the four ratios. Now we're going to look quickly at a profit and loss example. So we'll just draw a line over there, and we'll say P&L. Oops, not R&L. P&L. Example. Okay. First thing that comes into a business is revenue. Okay, sales. So sales come into a business. Then after sales, you've got cost of sales in brackets because it's negative. Then you've got your gross profit. Then you've got more expenses in brackets. Then you have your EBITDA. Earnings before interest, tax, depreciation, and amortization. So this is the firm profit. So the profit to the firm, the money that's left over after cost of sales and expenses to satisfy how the firm will pay its bills and retain cash in terms of equity profit. That's why EBITDA is used as a multiple in some cases to value businesses, because you're able to understand the firm value or an idea of the firm value. That's why EBITDA is a common number to use to apply a multiple to, determined in the industry sector, when you multiply it by the industry sector multiple to give you a value of the business. And we might cover a little bit more in other lives. Drop a comment if you want some other live sessions to cover different comps and different ways of valuing businesses. It does get very, very technical and very financial in terms of valuation. But that's EBITDA. Then you've got depreciation. So depreciation is another negative number in terms of profit and loss. Then you have EBIT, earnings before interest and tax. Then you have interest that comes off. Then you have profit before tax. Then you have tax. And then the shareholders get theirs, profit after tax. And that is the equity profit. I want to make sure you can see that there. That's the equity profit, profit after tax. And that's the firm profit. So what we're going to do is quickly draw the different areas of expense in a real example with numbers and percentages as to how you can think about profitability, the ability to manage expense to produce profit from sales. So wherever you are in the company, think about the sales that are coming in, the expense that's applied to that sale before you're able to keep some cash in the business to either reinvest or put out in dividends or etc. and use it how you want to use it. So another point I will say about thinking in this way, in terms of a growth mindset, in terms of, again, I'm repeating myself, ability to manage expense to produce profit for the business, then you honestly need to think about revenue being vanity, which means if you go after the big sales without thinking of profitability, then you're going after something to kind of show off. So revenue is vanity. Profit is sanity. So thinking about profit is sanity. Cash, profit after tax in the business, is the monarchy, which means cash is king or queen. Revenue is vanity, profit is sanity, cash is the monarchy. So let's apply some numbers to this so you can see it in an example. So revenue, we've got as firm sales. Just draw a line there so we can see. Firm sales. Then EBITDA, we know, is firm profit. Profit after tax is the equity profit. Profit after tax is equity profit. So what we're going to do is I'm just going to put some numbers in here now. So we'll use well, it can be any number, it can be any currency. So pounds, dollars, euros, yen, wherever you are, the same example. Oops, the same example applies. Okay. So let's say we'll just draw a line down here so we get it all in. Cool. That's a draftsman line, that. So I used to in my original career, right from school, I started off as an architectural technologist. So I got used to drawing straight-ish lines. So let's say we can work in thousands, millions, billions. I talk about this in all my videos. Applying those names sometimes can baffle people. When you think it's billions, you think, whoa, that must be massive. Whereas if you're able to condense things down, then the process is exactly the same, irrespective of the numbers that you're using. And so let's say, just for argument's sake, this is in thousands, and you're making 2,000 in revenue. So that's 2 million in whichever currency in sales. So 2,000. Then let's say cost of sales is 500, which makes the gross profit 1,500. Okay. So going back to profitability, how can you manage the expense of cost of sales to increase your gross profit? And that's how I'm hoping to instill this thought process to you, where when you're selling and when you're delivering or operating a business, think about the management of the expense in order for you to achieve more profit. How can you add value also to allow you to charge optimum prices for you to have a very efficient expense, in this case cost of sales, to give you a greater profit margin? Then you have to pay expenses. So we'll say, for argument's sake, that this is 700, which makes your EBITDA 800. So if you were to apply a 3x EBITDA to this business based on comps, based on industry comparisons of the multiples of transactions that have happened, for example, then if we were working in millions at a 3 times multiple EBITDA rate, then it would make this business 2.4 million in value, in theory, based on comps and things like that, because that's the EBITDA multiple. Then you need to depreciate based on the assets in the business. So we'll say we depreciate at 50. So all of these numbers in brackets, if you're managing a business, leading a business, starting a business, then it's more the brackets that you need to understand as much as the sales. In terms of a lot of people think, I need to get my price point right, I need to go out and market it, which are all good things. Understanding where the expenses are that you need to manage in order to increase your profitability, then it will set you in much more stead, and your business plans will be much more sustainable if you're able to think about and manage the expense, which makes the EBIT 750. Okay, then you have to pay interest, so you've got to pay the bank. The bank gets theirs, the tax person gets theirs before the firm, the equity profit is added into the balance sheet. Retained cash is added into the balance sheet. So think about the level of debt that's within the business, short term and long term, that interest is paid on, and that will be covered in terms of cash flow and balance and the balance sheet. So paying interest at 20, which then puts your profit before tax at 730. And then tax person is going to get theirs, so we'll say 30 for tax, which makes your retained profit after tax a nice 700. Cool. So let's just make sure that these things have all worked out right, because we're going to add in some percentages now. So just to make this a bit more real, we've got our firm sales, firm profit, EBITDA, and we've got equity profit, profit after tax. So now we're able to look to understand the gross profit, which is around 75%. which is a good GP. Then paying expenses, which brings EBITDA down to 800, which means that they're at a 40% EBITDA. And then EBIT, if we wanted to calculate that, that would be 37.5%. And then profit before tax and profit after tax, we're able to calculate those as percentages as well. And so if we were able to establish, so that those will be about the same in terms of the sales, 34 and 35%. Okay. So being able to look at these numbers like this, it's more around understanding the numbers in the brackets. How can you optimize and manage the expenses going out of the business to increase the cash within the business? And then you might want to reinvest that cash into the business and buy more assets. You might want to use it for acquisitions. You might want to use it to pay shareholders and things like that. But understanding that revenue is vanity, profit is sanity, and cash is the monarchy, then you're able to start to establish more of a growth mindset. So yes, you can make that sale. Yes, you can run and operate a business. Yes, you can create that business plan. And obviously think about how things are going to sell, how well they're going to sell. Think about competitors and price points and unique selling points. Don't ever forget customer value, because it's customer value that will allow you to not only increase price, it will allow you to make more sales, and it will allow you to optimize and manage your expenses more effectively, because you eliminate waste within your business that prevents your people from delivering customer value. So that's another key point also, is understanding customer value, what happens between selling and buying, because you will understand very quickly not just the sales coming into the business, but being able to more effectively manage the expenses going out of the business. So cost of sales, do you want to make that more efficient? Do you want to outsource for a better price of some things? Same with expenses. Do you have a greater operation that can either deliver more at the same expense to optimize processes and things like that? Do you have a way of doing things that is actually inhibiting your people from delivering customer value, which has prevented you from increasing prices, which has then affected service delivery, which has then affected sales? And so you are able to understand these things by talking to your people, talking to your customers, and by looking at the P&L, profit and loss, and having that mindset as to, awesome, made a sale. What's it going to take from my business to deliver that sale, and for us to be able to manage expense effectively for the optimum amount of profit? And that's where we're going with this analogy for financial health. That's why it's called health as well, because it's not just an accountant's job. It's not the financial analyst's job just to create these statements. When you're thinking in terms of profit and loss, in terms of the health of your own business, more effectively how to manage the expenses from leaving the business, it all comes down to, again, profitability. So when someone is looking at your business to buy it, they might be looking at it from a competitive standpoint. There might be a competitor of yours. They might be looking at you might be wanting to pitch to other investors or to other prospective clients as well. And clients may want to understand your financial health and your profitability to ensure that you've got a sustainable business model. And so financial health and profitability are a good way to think of how to grow the business, how to start one from scratch, not just with sales and obviously how you're going to make money, but think more accurately about the expenses and how your ability compares to manage those expenses to drive profit into the business. So we're going to go live again tomorrow. We're going to cover a couple more of these ratios and a couple more of the financial statements as well. But if you have any questions around your financial health of your business, then feel free to book a call with me. There's a link on my LinkedIn profile for a 15-minute discovery call. Be sure to check out TheStrategySmith.com as well. There's some announcements coming out soon, very soon, also with regards to some more services that we're going to be delivering from the Strategy Smith. And feel free to drop me any questions and in the comments. So I will see you all tomorrow. Have a good evening.